Welcome to the Deep Dive. We're here to take complex financial and legal research, break it down, and really give you the crucial knowledge you need.
And today we're diving into something that's, well, notoriously complex and definitely high stakes: estate and inheritance taxes.
Yeah, it's a topic that often comes up during really stressful times, which makes being prepared beforehand just so important.
Absolutely. Our goal today is clarity. We want to cut through the jargon, figure out who pays what, why, and what happens when federal and state rules seem to clash.
Okay, let's start right at the foundation, because I think if you mix these two up, you're lost from the start. What is the fundamental difference between an estate tax and an inheritance tax?
It's simple conceptually, but everything hinges on it. The estate tax, that's a tax on the total value of everything the person owned when they died.
Okay.
The estate itself pays that tax before anything gets distributed to the heirs.
Got it. So the pie shrinks before anyone gets a slice.
Exactly. Now, an inheritance tax is different. It's levied against the recipient, the heir, based on what they receive.
Ah, so the slice itself gets taxed after it's served.
Precisely. The heir pays the tax bill on their specific inheritance.
And this is where geography gets complicated, right? Because where the tax is paid depends on which type it is.
That's right, and it's a key planning point.
Yes.
Estate taxes are generally paid to the state where the deceased person lived.
Okay, makes sense.
But inheritance taxes, they're levied by the state where the beneficiary lives. So you could live in a state with an inheritance tax and owe tax on money you inherit from someone who lived and died in a state with no tax at all.
Wow, okay. That's a twist. Let's talk federal first, though, because that's often what people think of, right? The big IRS tax bill.
It is. But the reality is, for almost everyone listening, the federal estate tax is, frankly, a non-issue.
Really? Why is that?
The threshold is just incredibly high. It's designed to apply only to, well, the very wealthiest estates.
And the number for 2024?
For 2024, estates valued at less than $13.61 million are completely exempt from federal estate tax.
13.61 million. Okay, that is a huge number.
It is.
But what if an estate is over that? The rates listed go from 18% up to 40%. But I read something interesting that it often acts like a flat tax once you cross the threshold. How does that work?
Yeah, that's a really sharp observation. So while there are technically brackets, they climb very, very fast. And because of that huge initial exemption, that $13.61 million credit,
Right.
the moment you actually start paying the tax, you're essentially already in the top bracket or very close to it. So effectively, anything above that $13.61 million gets hit at or near that 40% rate.
So it simplifies things for those very few, very large estates.
Exactly. Less calculation needed once you're over the line.
Okay, so federal tax. High bar, rarely hit. Let's pivot then. State taxes. This sounds like where most people are more likely to feel the pinch.
Absolutely. This is where it gets much more relevant for many families. The state thresholds are just drastically lower.
How low are we talking?
Well, forget $13 million. Many estate tax exemptions start kicking in around, say, $1 million, maybe $2 million, maybe a bit more depending on the state, but significantly lower.
That's a massive difference. So, ballpark, how many states are we talking about?
Roughly 12 states plus D.C. have an estate tax, and then there are 6 states with an inheritance tax. So about 18 jurisdictions in total have one or the other.
And didn't you mention one state does both?
Ah, yes. The special case, Maryland. Maryland is the only state that levies both an estate tax on the decedent's assets and an inheritance tax on what the beneficiaries receive.
Whoa, hang on. Unpack that. If someone lives and dies in Maryland and leaves money to, say, their niece who also lives in Maryland, they get hit twice.
Potentially, yes. The estate might have to pay Maryland estate tax if it's over their threshold. And then the niece, because she isn't usually exempt like a child would be, she would also have to pay Maryland's inheritance tax on the amount she receives. It's a potential double hit, which really highlights why knowing the state rules and the relationship is so critical.
Okay. Can we quickly list the states for each type? So estate tax states where the estate pays.
Sure. That's Connecticut, D.C., Hawaii, Illinois, Maine, Maryland, again, Massachusetts, Minnesota, New York, Oregon, Rhode Island, Vermont, and Washington State.
Got it. And the rates there?
Typically start around 10%, maybe climb up towards 16%, often on a sliding scale like income tax.
Okay. And now the inheritance tax states where the beneficiary pays based on where they live.
Right, that's a shorter list. Iowa, Kentucky, Maryland again, Nebraska, New Jersey, and Pennsylvania.
And the rates there?
Usually start lower, maybe single digits.
Yeah.
But can go up to 15% or even 18%. But the key thing here
Yes.
is that the rate and the exemption often depend heavily on the relationship of the heir to the person who died, sometimes more than the actual dollar amount.
So who you are matters as much as how much you get.
Precisely. In Kentucky, for example, inheriting $500,000 might mean 0% tax if you're a child, but maybe 16% if you're a cousin or a friend. It all depends on that connection.
Okay, that's a lot to track state by state. Let's talk about who gets a pass, though. Exemptions and deductions. The big one seems to be for spouses.
Absolutely critical. This is the bedrock for many couples. The unlimited marital deduction. It means a surviving spouse is generally exempt from both federal and state estate taxes. Full stop.
No matter the amount.
No matter the amount transferred to the surviving spouse. And furthermore, spouses are also exempt from inheritance tax in all 6 states that have one. Transferring assets to your spouse doesn't trigger these taxes.
That's huge. What about kids, grandkids, direct descendants?
Mostly good news there, too, especially for inheritance tax. Most states with an inheritance tax, like Pennsylvania, fully exempt children and often grandchildren. A few states might have some nuances, but direct descendants usually pay 0 inheritance tax.
Okay. Now let's shift from the people to the assets. How are things like stocks or real estate valued? Is it what was paid originally or?
No, never the original price.
Yep.
It's always the asset's fair market value, FMV, on the date of death. So if a stock was bought for $10, but it's worth $100 when the person passes away, $100 is the value used for the estate calculation. This can actually be a big benefit later for income taxes, the whole stepped-up basis. But for estate tax, it's FMV'd at death.
Right, that step up is a whole other conversation. You also mentioned some flexibility for accountants in picking the valuation date.
Yes, that's an important planning tool. The estate can choose the date of death value, or they can elect the alternate valuation date, AVD, which is 6 months after the date of death.
Why would they do that?
Well, imagine an estate holds a lot of stocks, and the market drops significantly in the 6 months after the person died. The executor can choose the AVD, use those lower values, and potentially reduce or even eliminate the estate tax owed.
Ah, clever. A way to manage volatility. What else gets subtracted before they calculate the tax?
Standard things, mostly. Any debts the person owed, funeral expenses, administrative costs like legal or executor fees, and any charitable donations made from the estate. Those all come off the top.
Okay, let's talk life insurance. Lots of money moves this way. When does it get tangled up in these taxes?
The general rule is pretty straightforward. If the proceeds are paid directly to a named beneficiary like a spouse, a child, a specific person, it usually bypasses the whole estate process.
So no estate tax, no inheritance tax.
Generally, yes.
Right.
And it's usually federal income tax-free, too. It goes straight to the person named.
But there's a catch, right?
There's a huge catch.
Yeah.
If the life insurance policy is payable to the deceased person's estate, or if there's no named beneficiary,
Then what?
then those proceeds flow into the estate, become part of the total assets, and are counted when figuring out if estate tax is due. That payout could easily be the thing that pushes an estate over the state, or even the federal threshold.
So naming a specific beneficiary is absolutely crucial.
Foundational. It's one of the simplest, most effective planning steps.
Okay, let's move into more advanced planning then. For people who are clearly over the state or federal limits, what strategies do they use? Trusts seem like the main tool.
Trusts are definitely central. The basic idea is to move assets out of your personal ownership during your lifetime, putting them into a trust structure so they aren't counted as part of your taxable estate when you die.
We saw a couple of pretty technical examples mentioned. One was the Intentionally Defective Grantor Trust, an IDGT. That name sounds wrong.
It does sound odd, doesn't it? But the defective part is actually the key. It's set up deliberately so that for income tax purposes, the person who created the trust, the grantor, is still responsible for paying the income taxes the trust assets generate.
Wait, why would you want to pay taxes on assets you technically don't own anymore?
Because here's the brilliant part. For estate tax purposes, those assets are considered outside the grantor's estate. So by the grantor paying the income tax each year, the assets inside the trust can grow and compound completely tax-free for the beneficiaries down the line. That tax payment by the grantor is essentially a tax-free gift to the trust, letting it grow faster without hitting gift tax limits. It's a powerful way to shift wealth across generations.
Wow, okay, that's sophisticated. And what about that life insurance problem, the proceeds going to the estate? Is there a trust for that?
Yes, the Irrevocable Life Insurance Trust, or ILET. Its main job is simply to own the life insurance policy. That way, when the insured person dies, the proceeds go to the trust, not the estate, and are distributed according to the trust's terms avoiding estate taxes.
So the islet becomes the owner and beneficiary.
Exactly. Or you could also simply transfer ownership of the policy directly to, say, your adult child. But there's usually a look-back period, often 3 years, meaning if you die within that time, it might still be pulled back into your estate. And ILET avoids that issue.
Got it. And beyond trusts, you mentioned gifting.
Right. Strategic gifting is key.
Yeah.
Each year, you can give away a certain amount, the annual exclusion amount, to as many people as you want, completely free of gift or estate tax consequences. Doing that consistently over many years can move significant wealth out of a potentially taxable estate.
Okay, lots of planning options there. Now for something really different, actually declining an inheritance. Using a waiver. Why on earth would someone turn down free money or assets?
It sounds counterintuitive, I know, but there are very practical reasons. One is taxes, believe it or not. If accepting an inheritance pushes you, the beneficiary, into owing state inheritance tax that you can't easily pay, you might waive it.
Okay, maybe. What else?
Convenience or burden. Maybe you inherit a piece of property hundreds of miles away that's in terrible condition. You don't want the hassle or expense of fixing it up or selling it. Waiving it might be easier.
That makes sense. And there was a third, more defensive reason.
Yes, protecting the assets from your own financial troubles. If you're facing bankruptcy, a big lawsuit, or have major creditors, accepting a large inheritance means those assets could potentially be seized by your creditors. By properly waiving the inheritance, you legally never took possession, so it bypasses your financial problems and typically goes to the next person in line according to the will.
It's like a shield for the assets.
Exactly. A critical shield in some situations.
So this can't be casual. It has to be formal, legal.
Absolutely. You can't just tell the executor no thanks.
Yeah.
It needs to be a formal, written legal document, usually called a disclaimer or waiver. It has to state you're waiving freely, meet state requirements, and be filed with the probate court handling the estate. The executor needs a copy too.
And timing is critical here, right? There's a deadline.
A very strict deadline. Generally, you have 9 months from the date of the person's death to file that waiver.
9 months. Okay.
If you miss that deadline, the law typically says you've implicitly accepted the inheritance, whether you wanted it or not. You lose the option to waive.
And that 9 months, that number sounds familiar.
It should. It generally lines up with the deadline for paying most federal and state estate and inheritance taxes. It creates this really compressed, often stressful period after someone passes away where all these major financial decisions and tax filings have to happen.
Right? A lot happening in a short window. One last thing on the waivers. If I waive my share, say $1 million, can I say, okay, give it to my sister instead?
Nope. That's a key rule. The person waiving cannot direct where the asset goes next.
Why not?
To prevent people from using waivers just to, say, skip a generation for tax purposes or control things after they've given up their right, the executor has to follow the will or trust document. If it names a contingent beneficiary, they get it. If not, it usually falls back into the main pot of the estate and gets distributed according to the will's general instructions or state law, often to the next of kin.
Okay, so the original deceased person's wishes, or the law, still control it.
Exactly.
This has been incredibly clarifying on a really tangled topic. So to recap the big takeaways for everyone listening. Remember that difference between estate tax, paid by the estate, and inheritance tax, paid by the recipient.
And crucially, remember that the state rules, with those much lower thresholds and varying rates based on relationship, are far more likely to impact you than the federal rules.
Don't forget the power of the unlimited marital deduction for spouses and the importance of properly naming beneficiaries, especially for life insurance.
And waivers, while unusual, have specific legal requirements and that very firm 9-month deadline.
So that final thought for people to consider.
Look, dealing with this comes at a difficult time. That 9-month clock for taxes and waivers starts ticking immediately after a death. The real value of understanding all this now isn't about avoiding death or taxes entirely. It's about being prepared. It's about using this knowledge before you're in that stressful 9-month window, so you can structure things to protect your loved ones from unnecessary tax burdens or complicated financial scrambles later on. Preparation is key.
Excellent point. Preparation makes all the difference. And with that thought, we'll conclude this deep dive.
Thanks for tuning in. We'll see you next time.